To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Let us now understand the 5-step model in detail. And what is the first step? The first step is identification of the contract. So, an entity has to identify that there is a contract with a customer. Please note these important terms. There has to be a customer and there has to be a contract with the customer. So, if there is an entity, for example, the reporting entity, and there is another party, there has to be a contract between these two and the other party must be a customer. Now, generally, what do we understand when we hear this term customer? Customer is someone who purchases some goods or some services from the supplier or from the seller. Now, say for example, Indigolearn has some old cameras which it wants to sell. And you as a student of Indigolearn, you are interested to purchase this old camera from Indigolearn. Now, for the purpose of Ind AS 115, can we say that you are a customer? So, for that, we have to look at the definition of the customer. How is the term customer defined? A customer is someone who has entered into a contract with the entity to obtain goods and services which are the output of ordinary activities of the entity. What does that mean? The customer has to purchase goods and services which are the output of the ordinary activities. What is the ordinary activity for Indigolearn? To create content and sell content. Is selling an old camera or old laptop, is that ordinary activity for Indigolearn? That is not ordinary activity for Indigolearn. So, when we say ordinary activity, the day-to-day operations or day-to-day activities what the entity carries out. If you recall the definition of inventory, even there we understood something in similar lines, right? So, here a customer is someone who would obtain goods and services which are the output of ordinary activities of the entity. So, ordinarily, if the entity, for example, Indigolearn is creating content and selling content, if you are purchasing classes, then you are a customer. But if you are purchasing an old camera, you are not a customer for the purpose of Ind AS 115. Then, where do we take that transaction? That transaction would be dealt by Ind AS 16 or Ind AS 105 as appropriate. And even there, principles that we would apply would be of Ind AS 115 itself. But you cannot cover that transaction and recognize revenue on that as a part of Ind AS 115. So, if Indigolearn sells classes to the students, then that transaction will be covered under Ind AS 115 and we will be recognizing revenue for that. Whereas, if we sell old computers, if we sell old camera, or if we sell something which is not the output of our ordinary activity, that cannot be classified as revenue. You will deal with it as per Ind AS 16 or as per Ind AS 105 as appropriate. Now, the thing that we have understood with this discussion is a customer must purchase or must enter into a transaction to obtain the output of goods or services which are from the ordinary activities of the entity, and there has to be a consideration as well. There has to be a consideration. Monetary, non-monetary, will come to it later, but there has to be a consideration. You will have to pay something to acquire those goods or services. Now, let's take another example. Say we own a property and as Indigolearn, we have given that property on rent. Now, the other party, will the other party be called a customer as per Ind AS 115? First thing, this transaction of giving out a property on rent would be classified under leases for Indigolearn. Second thing is that this is not the ordinary activity. So, even the other party cannot be called a customer for the purpose of Ind AS 115. Okay. So, you have to link the standards and understand where does a particular contract fall into, whether the contract falls into Ind AS 116 or it falls into Ind AS 115 or it is dealt by any other standard, right. Towards the end of the standard, we will understand what are those transactions which are not covered by Ind AS 115. But for now, please understand that there would be an entity and there would be another party which has to be a customer, and the standard makes it very clear that if the other party is not a customer, then you cannot apply Ind AS 115. If the other party is not a customer, then you cannot apply Ind AS 115. Say for example, two entities come together and jointly they want to develop something. Okay, they are carrying out a joint, it is a form of joint arrangement. Then, if the other party is not a customer, it does not fall in the purview of Ind AS 115. This is the first thing that you need to understand absolutely clearly, that there has to be a customer as defined under Ind AS 115 if you want to recognize revenue from those customers. So, let's have a look at the definition. Customer is a party that has contracted with an entity, Entity here is the reporting entity, to obtain goods or services. So they'll obtain either goods or services that are an output of the entity's ordinary activities, which has to be an output of the entity's ordinary activities in exchange for consideration. This is the definition of a customer. Let me give you another example. You want to travel to Goa for holiday purpose. Okay. Now when you want to travel to Goa, you want to book a flight ticket. Now when you have to book a flight ticket, what do? You log on to makemytrip.com and there you start searching for flights. You select an appropriate flight and book the ticket. Now in this transaction we have you, we have Make My Trip, and let us say we have Indigo Airlines. Okay. Now when you book a ticket on Make My Trip, what Make My Trip does is, Make My Trip charges you something called as a convenience fee. Okay. So let us say they charge you 300 rupees plus GST, ignore GST for a moment, they charge you 300 rupees as convenience fee. So you pay 300 rupees as convenience fee to Make My Trip. Apart from that, you also pay the flight cost to Make My Trip, correct? Now what Make My Trip does is, Make My Trip also charges some commission from the airline company. So Indigo Airlines would pay some commission to Make My Trip. And ultimately if you see, the flight is provided by Indigo Airlines, you are traveling on that flight, and there is a third party, Make My Trip. Now, if you have to look at it from the point of view of Make My Trip, how many customers does it have? The first customer is you, where you are paying convenience fees. See, consideration is important. If Make My Trip does not charge anything from you, then you are not a customer. So when you are paying convenience fee, when you are paying a consideration, then you become a customer of Make My Trip. Apart from that, Indigo Airlines is also a customer for Make My Trip when Make My Trip arranges for customers on behalf of Indigo Airlines. So Indigo Airlines pays some commission to Make My Trip. There is a consideration involved. As far as Make My Trip is concerned, in a single transaction, it has two customers. One, you, the passenger. Second, the airline company. Now look at it from the point of view of Indigo Airlines. Does it have any customer? Yes, it also has a customer. The customer is you. Okay. For Indigo Airline, you are also the customer. Okay. So this is how we have to identify the customers, because to recognize revenue under Ind AS 115, there must be a customer. The next important aspect under step 1 is the contract. There has to be a contract. Now what is a contract? You would have learned about this in Contract Act. We discussed about contract in detail in Ind AS 116 as well, right? So similar logic will also apply here. There has to be a contract between the entity and the customer. Now this contract can be oral, it can be written, it can be implied, it can be as per business practices. For example, when you buy a product on Indigolearn, then you accept those terms and conditions. That acceptance of terms and condition itself forms the contract. And once you make the payment and we raise the invoice, the contract is in place, correct? So there has to be a contract. Need not always be in written form, but there has to be a contract. So the standard defines contract as an agreement between two or more parties that creates enforceable rights and obligations. So in the contract, there would be parties and there are enforceable rights and obligations. For example, when you purchase a product from Indigolearn, then you have an obligation to make the payment. We have an obligation to provide you the content, and on the other side you have the right to access the content and we have the right to receive the payment. Okay, so when we talk about a contract is an agreement which is enforceable and both the parties have some rights and obligations under the contract. So you have understood the meaning of contract. A contract is an agreement between two or more parties that creates enforceable rights and obligations. And when we say enforceable, it must be enforceable in the courts of law. If one of the party does not perform, the other party can approach law, they can take legal route and get the contract performed or claim compensation for non-performance. That is what is called a contract. Now, take a case where there is a contract between two parties, let us say entity and the customer, and either of these parties can cancel the contract, can move out of the contract without significant penalties, then that contract is not enforceable. Similar to the logic that we learned in 116, if one of the parties can exit from the contract, they can terminate the contract without significant penalties, then that contract is not enforceable. And for a contract to be recognized under Ind AS 115, the contract must be enforceable. Now say for example, you want to join a gym. Now when you join a gym, there is a 3 months initial non-cancelable period. That is, for the first 3 months, you cannot terminate the contract, and after that, you can renew it on a monthly basis. Now, for the purpose of Ind AS 115, the contract will be considered as a 3 months contract because that is the contractual period in which you cannot exit from the contract. And even if you want to terminate the contract or do not want to, access the gym facilities, you will not get the money back. The gym owner will not refund you the money. So you would be incurring significant loss, or the gym owner has already collected the money in advance, and which is non-refundable, and hence this contract is enforceable for a period of 3 months. And after that, on a monthly basis, when you renew, it would be considered to be a monthly contract. Okay. Now, why is it important? It is important because you have to decide that there is a contract which is enforceable. So, initially it is enforceable for 3 months, and then it is enforceable on a month-on-month basis. So, this is the crux of a contract, an agreement which creates enforceable rights and obligations. Now, as I said earlier, the first step under the 5-step model is identifying the contract, and in the first step there are 5 conditions. Ind AS 115 prescribes 5 conditions which have to be fulfilled for an entity to recognize a contract. So, to pass the first step, that is step 1, there are 5 conditions, and if any of these conditions are not satisfied, the first step is not passed and you cannot move on to other steps. So, to avoid confusion, what you need to understand is there is a 5-step model. The first step is identifying the contract. Under the first step of identifying the contract, there are 5 criteria which have to be met in order to recognize a contract under Ind AS 115. Under Ind AS 115, those 5 criteria have to be met. What are those 5 criteria? The first criteria is the parties must have approved the contract and they must be committed to perform their respective obligation. So, it has to be an approved contract. Approval can be, as I told earlier, oral, it can be written, it can be based on customary practices, it can be based on any of these 3, but it has to be an approved contract, and the parties must be committed to perform their obligation. So, all the parties, they must be committed, means they want to perform their respective obligation. It may be possible that in the past they have not performed their obligation, but they have the commitment to perform their obligations under the contract. Now, this involves a lot of judgment. But once the contract is approved, when the contract is signed off, generally we can assume that each party is committed to perform their obligation. That is the first thing. Otherwise, if they do not perform their obligation, they may be subject to penalties under the contract. That is the first condition. The second condition or the second criteria is the entity can identify each party's rights regarding the goods or services to be transferred. So, the entity must be able to identify each party's right. Each party's right meaning what is the right of the entity, what is the right of the other party. It must be able to identify it clearly. Now, in the example of Make My Trip that I gave you, assuming Make My Trip is the entity and you are the customer on one side and there is Indigo Airlines as a customer on the other side. Now, Make My Trip must be able to identify what is your right. What is your right? To get a valid ticket from Indigo Airlines, you must be able to travel on that particular date, right? Whatever is agreed upon between customer and Make My Trip must be able to identify, yes, these are the rights of the customers. Similarly, what are the rights of Indigo Airlines? It must be able to identify that. And also, what are its own right? How much amount it has to collect? All of that it must be able to identify. Then, the third step talks about the entity can identify the payment terms for the goods or services to be transferred. Now, what is the meaning of this? The entity must be able to identify what would be the terms of payment. As far as amount is concerned, that is a separate step, right? We talked about in the 5-step model, determination of transaction price. That is a separate step altogether. But the terms of payment must be identified. The entity must be able to identify what would be the terms of payment, how will they be settled, right? If there is a default, then what would happen? Are there any discounts applicable? Whatever is relevant in the contract, the entity must be able to identify that. Then, the fourth criteria is the contract must have a commercial substance. Now, what is the meaning of commercial substance? Recall Ind AS 16, recall Ind AS 38. We have learned about commercial substance there. Commercial substance basically means by entering into this contract, the nature, the risk, the timing of the cash flows of the entity would change. Now, to understand this, let us take a few examples. Say for example, we have Bharat Petroleum which has refinery in Mumbai. We have Indian Oil which has refinery in Paradip in Odisha. Now, Indian Oil has some pumps in Mumbai. Similarly, Bharat Petroleum has some pumps in Odisha. And let's say if Bharat Petroleum wants to move petrol from their refinery in Mumbai to Odisha, it will involve some amount of cost. Similarly for IOCL also, they will be incurring cost to move petrol from Odisha to Mumbai. So, what they do is they enter into an exchange transaction. What is the exchange transaction? BPCL says, we will supply some quantity of oil to your pumps in Mumbai. you supply same quantity of oil to our pumps in Odisha. Okay. Now, this is an exchange transaction. Now, as far as this exchange transaction is concerned, this is an exchange of product, and if you look at it, as far as the revenues of the enterprise are concerned, that is not going to change. They will save some amount on the transportation, but largely the risk, the nature, the timing of cash flows would not change, correct? And we can say that this transaction does not have commercial substance, and this will not be a part of Ind AS 115. The contract will not be covered under Ind AS 115. It is a pure exchange transaction, and commodities are being exchanged just to facilitate supplies to the customers. And in fact, in the scope exclusions, these kind of transactions are excluded from the scope of the contract itself. Now, I gave you this example of oil exchange to help you understand the meaning of commercial substance. When you are exchanging similar products, the transaction generally lacks commercial substance. Now, let me slightly change the example and say what IOCL says is, BPCL, you supply some petrol, some diesel to my pumps in Mumbai, and whatever is the transaction price, whatever is the price of the goods that you supply, I will pay you the amount. Similarly, BPCL says, you supply some quantity to my pumps in Odisha, I will pay you the amount for that. We can do a net settlement. Now, here in the second case, there is no exchange happening. It is an independent sale transaction. IOCL is selling product to BPCL independently, and BPCL is selling petrol to IOCL pumps in Mumbai independent. Now, there each transaction is independent. There is an independent sale transaction. It is not an exchange transaction. Okay. If it is not an exchange transaction, if the transaction involves commercial substance, then that contract will be covered under Ind AS 115. So, now what you need to understand is whether the contract has a commercial substance or not. Let me give you another example. Say we have entity A and we have entity B, and then there is another entity, entity C. What entity A does is, A sells goods to B, B sells the same goods to C, and C sells the same goods back to A. They have just routed the transaction. A has sold to B, B has sold to C, and C has sold back to A. Okay. Now, if you look at the substance of the transaction, product has come back to A, and in the entire journey, A will also show revenue or sales, B will also show sales, and C will also show sales. Now, if you look at the substance of the transaction, the inventory has come back as it is to entity A, and in such cases, what Ind AS 115 says is, this transaction does not have commercial substance, and hence revenue should not be recognized. Now, you might be wondering, sir, as per GST, there will be a sale, we will have to pay we will have to pay tax on that. Yes, you will have to pay tax on that, that is independent. Then second question is, how will someone identify whether same goods have come back or not? Generally, if you follow products, you will have something called as a batch number, referring to the batch number or referring to the lot number, right? You will be able to identify whether it is the same product which has come back or not. So, it is more of a judgment whether the transaction has commercial substance or not. So, the way you need to look at this particular provision is, if by entering into the contract, the nature, the timing, the amount of cash flows, if it doesn't change, then the transaction does not have commercial substance, and hence it cannot be recognized as a contract for the purpose of Ind AS 115. But if the transaction has a commercial substance, then you will recognize that transaction as a part of Ind AS 115 under revenue, right? So, this is what you need to understand when we talk about commercial substance. And please note, if there are exchange of homogeneous product for facilitation to supplies to customers, then Ind AS 115 excludes those contracts from the scope itself, okay? Now, I gave you the example of oil exchange just to explain you the commercial substance, right? So, if there is exchange of product which are homogeneous, same quantities, then it does not have commercial substance. But if there is a outright sale independently, then each contract will be recognized as a contract under Ind AS 115. Then, say for example, there is one electricity company and mobile phone company. Electricity company says, I will supply you some units of electricity. Mobile phone company says, okay, I will provide you telecom service for some amount or for some units. Now, in this transaction, is there a commercial substance? See, for each of them, the cash flows would be changing. For each of them, the product that is being exchanged is not same, and hence this transaction is likely to have a commercial substance, and the contract can be recognized as per Ind AS 115. So, it is more of a matter of judgment rather than a rule of thumb saying that, okay, if this happens, then there is commercial substance, if this happens, then there is no commercial substance. Entity has to make a judgment as to whether there is a commercial substance involved in the transaction or not. Then lastly, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. So, the last point talks about collectibility. Now, if you recall AS9, there also we had something like, if the collectibility is not certain, we have to defer revenue and all of that. it has been more specifically crystallized as a part of the step itself. So what is the last step? It is probable, that is more than 50% chance that the entity will be able to collect the consideration from the customer. Now, while doing this, what the entity needs to do is, it needs to decide on the inception of the contract that the customer has the ability to pay, it has a willingness to pay, and ultimately it will pay the amount to the entity. Subsequently, if the customer's financial situation gets bad, or subsequently the customer is not able to pay, then you do not reassess this step. At the time of inception of the contract itself, you will check whether it is probable that the entity will be able to collect the consideration that it is expecting to collect. If the answer to this is yes, then you will not again come back and keep on reassessing this step. So what you do is, once all these 5 criteria is satisfied, then you will not again come back and check for these criteria. Once these 5 criteria are satisfied, step 1 is clear, step 1 is passed, and then we can move on to step 2. Now to quickly summarize these 5 criteria, there has to be an approval to the contract, or the contract must be approved, and the parties must be committed to the obligations of the contract. That is the first thing. So there must be a contract. Then the second thing, the entity must be able to identify the rights of each of the party. First one was contract, second one is right. Then the third one is payment terms. The entity must be able to identify the payment terms. The fourth one is that the contract must have commercial substance. And the last one is, it is probable that the entity will be able to collect the consideration expected from the customer. So the way to remember is contract, right, payment, commercial substance, and collectibility. These 5 things is what you need to remember. So what you need to remember is CRPCC, contract, right, payment terms, commercial substance, and collectibility, right. Once all these 5 criteria is met, the first step is passed. You have cleared the first step and you have identified the contract with the customer, and you can recognize the contract for the purpose of Ind AS 115. Let us now take few examples and understand in each of the scenarios whether we can recognize the contract, whether we can say that the contract is in existence, or when should we recognize the revenue, right. All of those things we will understand by taking some examples. Say we have Tata Motors and we have Samsung mobiles. Now Tata Motors wants some mobile phones for its employees, and what it does is it approaches Samsung and says, we want 1000 mobile phones of this particular model. Samsung India says okay, and till this time price and payment terms have not been agreed into. Means Tata Motors has not agreed the price, neither Samsung mobiles have quoted the price. The price part is not yet agreed upon. How the payment will happen, even that is not agreed upon. Simply put, Tata Motors has placed an order without determining the price, and Samsung mobiles, trusting the creditworthiness of Tata Motors, they have shipped 1000 mobile phones. In real life this will not happen, I am just giving you a hypothetical situation. Now when 1000 mobile phones are shipped and Tata Motors has received those mobile phones, it has given it off to the employees, the customer, that is Tata Motors, is in control of those mobile phones, and Samsung has fulfilled its part of the obligation as well. Can we say that the contract can be identified? Now for the first step, that is identification of the contract, we need to see whether the 5 criteria have been met. What are those 5 criteria? C, contract, the rights, the payments. Now in this case I told you that the payment has not been agreed upon. They have not agreed upon the payment, and assume for a moment that Tata Motors has paid 10 lakhs as non-refundable deposit, non-refundable amount to Samsung India. Now can Samsung India say that I have transferred all the mobile phones, the control of the mobile phones is with Tata Motors, I have received 10 lakhs of non-refundable deposit, at least let me recognize this 10 lakh rupees as revenue? Can Samsung India do that? Now for this we need to look at the 5-step model. Under 5-step model, the first step is identification of the contract, and because the payment terms have not been finalized, the contract is not covered under Ind AS 115, and Samsung cannot recognize revenue. Samsung India cannot recognize revenue till the time step 1 is completed. And when will the step 1 be completed? When the payment terms are finalized. So it is very important to check each and every criteria before we say that the contract is covered under Ind AS 115 and revenue can be recognized. I agree that the control of the mobile phones is with the customer, but still then Samsung cannot recognize revenue. Then what will Samsung do with the 10 lakhs of amount that it has received? It will recognize it as a liability. Now continuing with the same example, let us understand when can Samsung recognize revenue even though any of the criteria under step 1 are not met. Any of them mean any of the criteria meaning one or more criteria under step 1 are not met, even then it can recognize revenue. When is that possible? Say for example, Tata Motors did not like the mobile phones and they returned back the mobile phones and said we are cancelling the contract. And Samsung is under no obligation to refund the amount paid because it was a non-refundable payment. Now, if this situation occurs, then Samsung can recognize revenue of 10 lakhs. That is the first case. And the second case could be Samsung has transferred the mobile phones. It is under no further obligation to provide any more mobile phones or any more goods or services under the contract. And Tata Motors has paid the entire consideration that it has agreed upon, and this payment is non-refundable. Assume for a moment the parties finally agreed that the amount of consideration should be 1 crore. Tata Motors paid 1 crore to Samsung. Okay. In that situation, if that 1 crore of payment is non-refundable, then also Samsung India can recognize revenue to the extent of that 1 crore. Okay. Now here what you need to understand is, if any of the criteria under step 1 are not met, meaning to say the gateway itself has failed, the gateway is not yet opened, even then an entity can recognize revenue if the contract is cancelled and the amount received from the customer is non-refundable, or the entity has performed its obligation of transfer of goods and services, it has no further obligation to transfer any more goods and services, and the customer has paid all or substantially all of the amount to the entity and this amount paid is non-refundable. In these two cases, even though if any of the criteria under step 1 are not satisfied, then also the entity can recognize revenue. So, when a contract with a customer does not meet the criteria specified in paragraph 9, that is the step 1 of the 5-step model, and an entity receives consideration from the customer, the entity shall recognize the consideration received as revenue only when either of the following events have occurred. The first is, entity has no remaining obligations to transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer has been received by the entity and is non-refundable, or the contract has been terminated and the consideration received from the customer is non-refundable. Now, you will be able to understand this better if I link this with the commercial substance related criteria. Say for example, the contract between the entity and the customer does not have commercial substance, okay, and the customer has paid some non-refundable consideration to the entity, and subsequently the contract is cancelled. And entity A is not required to refund the amount paid by the customer. In that case, the amount that has been received by entity A can be recognized as revenue. So, to summarize, under the first step there are 5 criteria and the entity has to check that all of the 5 criteria have been met. What are those 5 criteria relating to? Contract, the rights, the payment, the commercial substance and collectibility of the consideration. If all of these 5 criteria are met, then we can say step 1 is met. If any of those 5 criteria are not met, the entity has to continuously assess and check whether those criteria are met in the future. Now, say for example, one of these 5 criteria are not met, but the entity has transferred the goods and services and has received some consideration from the customer. Till the time these 5 criteria are not met, the consideration received from the customer will be shown as a liability. It will be shown as a liability. Now, when can the entity book a revenue out of this? The entity can recognize the revenue out of this either when all of the 5 criteria under step 1 are satisfied, that is the first case, or as per paragraph 15, those 2 events occur. What are those 2 events? The first event is that the contract is cancelled and the amount received is non-refundable, and the second case is the entity has no further obligation to transfer any goods or services and all or substantially all of the consideration promised by the customer is received and is non-refundable. So, either meet all the 5 criteria as per step 1, that is paragraph 9, then you can recognize revenue, or the event stated in paragraph 15, that is either the cancellation of contract or receipt or no further obligation on the entity and amount received from the customer which is non-refundable. If any of these 2 events happen, even then revenue can be recognized. Seems slightly complex, but you have to note this properly. Only then you will be able to decide when to recognize revenue. Now, a question may come to your mind as to why are we recognizing the consideration received from the customer as a liability? It is a liability for the entity because in the future either the entity has to transfer goods or provide services or maybe refund the amount. Now, is it the case that if the amount is non-refundable, we can recognize it as a revenue? Even then, we cannot recognize it as a revenue because of the conditions prescribed in paragraph 9 and paragraph 15. Only if those conditions are met, we can recognize revenue. Otherwise, we will have to show them as liability till the time those conditions are satisfied. Let's have a look at few questions. Company A has a customer P. So, this is the entity. When we say entity, the reporting entity, and they have a customer which is undergoing restructuring due to issues related to liquidity. So, there are some issues due to liquidity and they are undergoing a restructuring exercise. Company A has decided not to do any further business with P. Obviously, why will you do with P? P has informed company A that it will get letter of credit from a nationalized bank against which the company A can dispatch goods. Company A has manufactured the goods exclusively for P, but the letter of credit has not yet been arranged because it is in process. Determine whether the contract is identified. Now, here what is happening? There is one entity, there is a customer. The customer is facing difficulties, and because it is facing difficulties, the entity has decided that we will not do any transaction with you. Even though company A, that is the entity, they have manufactured certain goods specifically for the customer P, but still the transaction is not being entered into. Now, can we say that the contract is identified in this case? Now, if you remember, one of the 5 criteria, in the last criteria, we talked about collection of consideration being probable. Now, here, is the collection of consideration probable? The customer is facing difficulties. Letter of credit will be arranged. Letter of credit is not yet arranged. It will be arranged and it is still in process. So, till the time the company receives letter of credit from the bank, till such time the company will not have comfort that they will be able to collect the consideration, right? So, till the time the collection of consideration is not probable, you cannot say that the contract is identified. And because the contract is not identified, step 1 of the 5-step model is not passed. And even if the customer pays some amount in advance as a consideration or as a deposit, company A cannot recognize revenue. It will have to show those amount as a liability. Next question. An entity G Limited enters into a contract with a customer P Limited for the sale of a machinery for rupees 20 lakhs. P Limited intends to use the said machinery to start a food processing unit. The food processing industry is highly competitive and P Limited has little experience in the said industry. So, again here entity G has entered into a contract for sale of a machinery. So, for entity G, machinery may be inventory and entity customer P would be buying that machinery. And P Limited wants to start a food processing unit and the food processing unit is highly competitive and P Limited does not have, it has very little experience in the industry. P Limited pays a non-refundable deposit of rupees 1 lakh at the inception of the contract and enters into a long-term financing arrangement with G Limited. So, G Limited is again the company. So, what P Limited did? P Limited paid 1 lakh as non-refundable advance and it also entered into a financing arrangement with G Limited itself. Means G Limited will arrange for a finance for, means G Limited will give financing for this transaction. For the remaining 95% of the agreed consideration which it intends to pay primarily from the income derived from its food processing unit, as it lacks any other major source of income. So, the customer has entered into a financing arrangement with G Limited and said that I will repay the amount pertaining to this financing arrangement by utilizing the proceeds from the unit that will be set up. Then the financing arrangement is provided on a non-recourse basis. Now, what is the meaning of this non-recourse basis? Remember the concepts that you learned in financial management at CA Inter. What is this non-recourse? Non-recourse basically means if P Limited does not pay the amount, then G Limited can get back the machinery. It can collect back its machinery, but it will not be able to collect the amount from G Limited. So, here the customer, that is P Limited, if they have the financial ability to pay, they will pay. If they are not in a position to pay, then G Limited, that is the entity, can take back the machinery, but it will not be able to collect the amount in the future. Cash will not come, only the machinery can come back. That is what is the meaning of non-recourse basis. Which means that if P Limited defaults, then G Limited can repossess the machinery but cannot seek further compensation from P Limited even if the full value of the amount owed is not recovered from the machinery. So, G Limited says, I don't have money, you please take back the machinery. I will not pay anything extra. Maybe the amount of machinery is less than the amount recoverable from P Limited in the future. Even then, P Limited will only give back the machinery, they will not pay anything beyond that. The cost of the machinery for G Limited is 12 lakhs. So, the cost is 12 lakhs and they have agreed to sell it for 20 lakhs. P Limited obtains the control of the machinery at contract inception. So, at the inception of the contract, control is transferred to P Limited. When should G Limited recognize revenue from the sale of machinery to P Limited in accordance with paragraph 9 of Ind AS 115? So, friends, paragraph 9 of Ind AS 115 talks about the 5 criteria, and the last criteria talks about consideration. It must be probable that the entity will collect the consideration expected from the customers by providing those goods and services. So, now here if you look at the facts of the case, first the industry is competitive, P Limited does not have experience, and P Limited wants to pay the amount out of the proceeds that it generates by running that food processing unit. It doesn't have experience, so how much it will generate we don't know. And even if it defaults, the entity will get back the machine. It will not get back any further consideration from the customer. And hence, here we can say that the last criteria, that is related to consideration, is not being met, and hence the entity will not be able to recognize revenue. So, G Limited will not be able to recognize revenue. What will happen to the non-refundable deposit? You will show it as a liability till the time either the criteria given in paragraph 9 are satisfied, that is the 5 criteria, and here the criteria related to consideration is the one which is relevant, and or any of the conditions given in paragraph 15 is satisfied. That is, either the entity receives all or substantially all of the consideration and that consideration is non-refundable. Anyways, there are no further obligation because the machinery has been transferred, or the contract is cancelled and the amount becomes non-refundable. So, let us say at a future date P Limited defaults. If P Limited defaults, G Limited will take back the machine, the contract would be cancelled, and this non-refundable deposit of how much? Of 1 lakh. That non-refundable deposit will not be refunded, and you will recognize it as a revenue at that point of time. Let's have a look at another question. X Limited provides IT support services to its customer from a distant location. Customers call up the support team of X Limited, who understand the client's requirement over the phone and provide necessary advice to the customer to resolve their issue. Before providing advice, the support team members will understand the client's problem and inform them about the price for the services to be provided. Once the problem is resolved, the customer will make agreed payment to X Limited through online banking mode. X Limited considers that collection is probable and the oral contract is enforceable as per the law applicable in the jurisdiction of X. In such a case, whether there is a valid contract in accordance with Ind AS 115. Now, for a contract to be a valid contract under Ind AS 115, we have to check the 5 criteria. What are the 5 criteria? Contract must be approved. Now, approval can be oral approval as well. Now, here, because the support team agrees with the customer about the contract, they will understand the customer's problem. They also agree upon the price. So, there is an approved contract. Okay, the oral approval can also be considered to be approved contract, and the question itself says that such contracts are enforceable in the jurisdiction of X Limited. So, contract is approved. Then the second thing is right. So, under the contract, the entity must be able to identify the right of the customer and the right of the entity. Then the payment terms. Now, here the support team will explain what is the price payable, and the customers would pay the price through online banking channel. So, even that condition is met. Then transaction having commercial substance. So, here obviously when you are providing service, it would have a commercial substance. And lastly, probability of collection of considerations. The question says that X Limited considers that the collection is probable. So, the probability of collection is also met, and hence all the 5 criteria under paragraph 9 are met, and we can say that there is a valid contract in this case.